and some mitigation tactics to alleviate that risk as well. Today we have Vaibhav Laddha and Neil Borate with us for this discussion. Let me quickly introduce these two gentlemen for everyone's benefit. Vaibhav Laddha is the CEO of Grip Invest, an alternative investment platform offering high yield investments starting at just 1,000 rupees. Over the last decade, he has held leadership positions scaling early stage startups both in India and the US, focusing on creating structured financial products, accessing the private wealth ecosystem, and building consumer products. He holds, sorry, give me one second. He holds an MBA from Darden School of Business, University of Virginia, and is also an alumnus of IIT Delhi. Vaibhav, welcome to this podcast. Um,
Thanks, Yash. Pleasure to be here.
uh, yeah. Moving on to our second guest, Neil. Most of you might already know him, but I'll give the introduction anyway. Neil Borate is the editor for the personal finance section at Mint. He has been with Mint for almost 5 years now. His team is known for creating beautiful and concise one-pager infographics, which are widely appreciated by the investing community. Neil is also a co-author of a national bestseller, The Big Bull of Dalal Street, which is based on the life of Rakesh Jhunjhunwala. Neil, absolute pleasure to host you for this webinar, and thank you for taking the time to be here on a Sunday and doing this live for our viewers.
Thanks for having me, Yash.
Um, uh, One second, Megha, we can hear everyone, right? Yeah, yeah. Okay, great. Great. So I'll quickly set some context for our audience. Today, along with these two guests, we'll be discussing some key questions like, okay, what is risk, and risk-adjusted returns? How to evaluate risk of equity and debt instruments? What is the risk in alternative investments? How to mitigate certain risks within your portfolio? What is the role of credit rating agencies? And many more questions like that. So do stay tuned till the end of this webinar. And at the end of this webinar, we'll also take some questions that you are putting in your live chats. This is the third webinar in our AltXtra series, which is curated by Alt Investor, that runs the largest community on alternative investments. The AltXtra series is powered by Grip Invest. I am Yash, and I'll be your host for this series. While I do discuss some key questions I have on this topic with these two gentlemen, I would request the audience to keep their questions incoming. There will be a chat box wherever you are watching this live. We will pick up as many questions we have at the end of this discussion and get them answered. Okay, Weber and Neil, ready to get started? All good?
Yes.
Yeah.
Absolutely.
Okay, Neil, let's start with you first. Fundamental question. What is risk? How do you define risk? Uh, to elongate that question, does every financial instrument have some form of risk? And what is considered risk-free as well?
Yeah. Uh, so, Yash, the conventional definition of risk is simply volatility or standard deviation. To put that in simple terms, is the upward and downward movement of an asset that you hold. But over the years, at the more meaningful definition is the risk of not meeting your goals with the risk that with the investment that you've made. So it doesn't
Hmm.
matter if the Nifty has gone up or down. You've, let's say, you've held it for a 5-year period and it's gone down 20% in that period and recovered. It doesn't matter to you. But what does matter is that you've held it for 5 years, but at the end of that, cumulatively, it's still down 30%,
Hmm.
and that's a problem. So I
Hmm.
would use the more meaningful definition that the risk of not meeting your financial goals with the instrument you picked.
Hmm. Okay. Neil, sorry, we are getting some comments from audience. Your voice is a little low. So maybe
Oh,
just
okay, okay. I will
yeah,
speak up.
yeah.
Uh,
That's the first comment that we got from Rachna. Neil's audio is very low, but yeah. Uh, okay, thank you. Weber, would you like to add anything to that? What is risk from your perspective?
Yeah. So I think, as Neil was also saying, risk should always be seen in commensuration to the return that you are expecting. Um, so yeah, the conventional definition of risk is basically sovereign risk, which is called as risk-free call it government bonds, call it government securities, which comes with a sovereign security, and that is basically risk free. Everything else comes with an element of risk, and yeah, as I think we'll discuss more with Neil on this podcast, we'll see how different asset classes come with different kinds of risk.
Hmm. Okay, fantastic point, Vaibhav. So I want to talk about different asset classes, starting with what is asset allocation. Globally, we have heard that investors should have a 60-40 portfolio, 60% being investment to equity or equity-like instruments, 40% being investment to debt or debt-like instruments. What part does risk play in defining asset allocation?
Sure. Let me just start with what is asset allocation. I think
Sure.
simply put, asset allocation is how widely or how is your net worth distributed across asset classes. So if you
Hmm.
have 100 rupee worth of net worth, then according to what you said, like 60 goes in equity, 40 goes in debt. But there are more asset classes like equity, debt, gold, real estate, cash, FD, so on and so forth. So this is the diversification across assets, which is called asset allocation. Why is it important? Asset allocation is very important to do two things. One is managing risk, and two is maximizing returns. And because see the asset classes, the same asset class doesn't behave similarly across time spans. In fact, I think Mint used to do this lovely piece of a matrix. Neil, do you still
Asset
do that?
allocation quilt.
Yeah,
Yeah,
the
yeah.
asset
We do
allocation
it
quilt.
on New Year's of every year. So,
Yeah, so it was
like,
end of the calendar year where the last decades, how different asset classes would perform over the last decade. So imagine like a 10 by 10 matrix. So 2014 to 2024 on the x-axis and all the asset classes on the y-axis. And that matrix was I loved it because what you could see in that matrix was in no two consecutive years the top quartile of the asset classes which performed really well and the bottom quartile which performed really bad would be the same. Okay, so asset classes behave differently over time, and that's why it is important, at least for common investors, to be invested in all asset classes and do that asset allocation. And here also it is important to not the classification is not just equity and debt. All equity is not the same equity. All debt is not same. So equity, for example, and I think the viewers will understand that better. Large cap, mid cap, small cap, they're all different kind of asset classes if you go deep into that. Similarly, fixed income, if you think you are investing in fixed deposits and that's the only fixed income, there are more asset classes to look at, right? And alt investor, of course, has been doing great work there, but definitely look for other asset classes in fixed income beyond fixed deposits. Um, yeah, you said a 60-40 rule globally. I think what is more, in common man's terms, what is more prevalent is your equity allocation should be 1 minus or 100 minus your age. So
Hmm.
if you're a 30-year old, then 70% goes into your equity. If you're 40, then 60%, and so on and so forth. Why? To your second point, the risk, because
Hmm.
uh, depending on what life stage you are in, depending on your liabilities, your responsibilities, you can take higher or lower risk, and that also defines your asset allocation. Um,
Hmm.
so how aggressive do you want to play in the market is the risk factor that defines your asset allocation. That's why I like this 1 minus age better than 60-40 because 60-40 may not apply to someone who's planning for their retirement plans, right?
Hmm.
Um, yeah, and then just to wrap up, like if you think about equity and debt as two major asset classes, equity comes with volatility, debt gives you that predictable fixed income, and that's why the asset allocation is important. In fact, one of the studies I read recently said that it's not which stock you buy, which mutual fund you put in, it's 90% of your returns are correlated with how well you were allocated across assets and not the
Hmm.
exact asset that you were invested in.
Okay, got it. Neil, anything to add on to that from your experience? I mean, do you agree with one minus age thing which Weber has said?
So I would say that both 60/40 and 1 minus age are rules of thumb that people use.
Hmm.
There is a more scientific way, which is if you consult a registered investment advisor, then they do a full risk profiling and they arrive at your asset allocation. But for those who don't want to go that far, these are good rules of thumb for sure. Just one more caveat. There's also, asset allocation is not equity and debt only, it's also gold, it's
Yeah.
also real estate. So those should also form part of your portfolio.
Do you think crypto should
Yeah,
form part of the portfolio? Neil?
Controversial question. Um, in most cases, no, but there is a
Okay.
small minority of, yeah,
Okay.
most cases, no.
Weber, you were saying something?
I was just saying, so see, these are rules of thumb. Okay, one minus age is not an advisory rule in
Sure.
any manner, and I'll tell you the reason why. Because even the time period that you are in would make you change your asset allocation. So, for example, if the equity markets are overheated, then you should then go overweight on fixed income, right? If it's vice versa, then you should go overweight on equity. So asset allocation is a fluid concept, but for the large number of audience, what fits is that you don't have to always keep timing the market. Just stay invested across asset classes and do your asset allocation.
Hmm. Okay, got it. Um, Neil, in your experience of covering the personal finance journey of, let's say, thousands of individuals, do you think they are erratic in their decision making? Like, do they really consider asset allocation when they are making their investments, or they just invest based on the name of the issuer, the company, or based on the yield as well when it comes to fixed income instruments?
Yeah, so I'll in fact take one step back and explain how psychology works in a situation like now when we have had, arguably almost a decade of a bull market,
Hmm.
and post COVID it's become a raging bull market.
Hmm.
So I would wager that everyone's asset allocation has become skewed towards equity. Even the most conservative person, if in equilibrium they were going to allocate 20% to equity, now they would be at 25, they'd be at 30, and they would not be likely to sell. It's very hard to go against something that has rewarded you so handsomely.
Hmm.
And that also carries into fixed income. So when you have a raging bull market that's giving you 15-20% a year, you're going to demand a yield of 20% from your fixed income to keep up with it. And that's
Hmm.
where the problems come in. That's where you go and buy the high risk, the high yield stuff, and it skews your behavior. So all of us, I mean, look, most people talk the talk, but almost nobody walks the walk when it comes
Hmm.
to asset allocation.
Hmm. What about you, Neil? What's your asset allocation?
So I'll tell you, I hold my hands up. I've made multiple mistakes with that in the past,
Mhm.
but mistakes on the other side because I am inherently a bearish, pessimistic person. So when the market crashed in COVID and it rallied, I thought that the economy still looks shaky. There's some disconnect between the market and the economy. I redeemed my funds too early and I suffered. I have and getting back into the market was so hard. It took me months, in one case 1 year, to deploy some funds back into the market, and that too I went into hybrid funds. I couldn't go into pure equity. So I was swayed by the bear phase. I am better
Hmm.
against the bull phase because I'm inherently bearish. So I have a natural speed breaker, but we
Hmm.
all have those biases that creep in.
Hmm. Okay, got it. Weber, you head the wealth team as well at Grip, from what I understand, and you yourself talk to a lot of investors. Uh, can you also talk about a bit of the investor psyche? Do they invest just based on the name or the issuer or the yield, or people are a bit more rational in their investing decisions?
Yeah. So, see, the yields are always the headline numbers. Okay. I'm
Mhm.
talking about the broader community of investors. The yield is the headline number. And I don't blame investors for that because the opportunity has to match with your return expectations. That is the first thing. But the thing is that the only decisions based on only yields are not the right decisions.
Hmm.
High yields come with high risk. What kind of risk? All those things are that then the checklist that you have to follow to ascertain that those returns are actually worth the risk that you are taking or not.
Hmm.
Having said that, there's a there is a core group of investors at grip, like I would call it the core community. Every brand has those loyal customers, if you will. And for that group we have been able, or I'm seeing that change where people now understand the ratings,
Hmm.
the returns in commensuration to the rating, the security cover. Like now the investors ask me like, what's the security cover in this opportunity? And I feel very happy about it,
Hmm.
because for the most part, people only talk about returns without talking
Hmm.
about risk and security cover and what happens in the case of default and the recourse, etc., etc. So in my small subset, I'm seeing that change, but of course that subset is very, very small if you
Hmm.
talk about the broader investor community.
Hmm.
um,
Okay.
and I think vice versa, what Neil was saying, it also spills over in equity, where
Hmm.
people chase momentum. There's so many times when institutions, FIIs are pulling out, but investors, retail investors, are holding the bag for so long. So yeah, that investor psyche, I think, continues to remain.
Hmm. Okay. Got it. Neen, sorry. I think people still can't hear you very well. Do you have headphones by any chance?
Not. I'll just check.
Just see if we can do something. Sorry about that. Um,
No, I don't right now, but I can maybe bring the
yeah,
laptop.
maybe speak near to the laptop mic.
Yeah.
Uh, okay, that's
Hopefully.
fine.
Yeah.
Yeah, or maybe a bit louder.
Testing. Testing.
Uh,
Check. Is this better?
Audience, is it better? Yeah,
Testing.
should be
One, two,
better
three.
now. Should be
Okay.
better. Okay. So Neil, what can be uh, done to, let's say, change this behavior inherently? Like, how can, I mean, of course, you're doing a fantastic job in educating the consumer, but do you think there needs to be more done from a policy level by the government or SEBI? Actually, we'll not talk about SEBI right now because it's a bit controversial given the last night happenings. But what do you think can be done at a policy level to make people more educated in terms of the asset allocation, or even in improve rational decision making?
Yeah, so actually, from SEBI's front, there's been a very big positive development, which is the consultation paper on registered investment advisors and research analysts. Because I think, you can explain 90% of the problems in finance by looking at just the last mile. The mile of distribution is where the problems occur. And this circular, if it increases the number of RIAs, will go to fix it a great deal. Because when
Hmm.
it comes to product labeling, I mean, you can have all kinds of labels. Mutual funds have this riskometer which nobody pays attention to. You can have
Hmm.
that stock, you open your brokerage account and it tells you that SEBI study 90% people lose F&O. They click cross and they go and do F&O. So you can have all
Hmm.
kinds of labels on products and it makes no difference. But if you fix the incentives, if you fix the commissions at the last mile, you have fixed the problem.
Hmm. Okay. And Vaibhav, any opinion from you? How? I mean, I'm sure you have distributors, wealth managers working for you as well. How do you ensure these guys are also educating their customers to make rational decision making?
Yeah. See, I feel that the incentives will need to get aligned.
Hmm.
Distributors' incentives should be aligned with the end client incentives, and however, I would say there is a regulatory angle. There's we can blame the distributors for doing what they do, uh,
Hmm.
but I think the larger change will only come when the end investors get more and more aware on what
Hmm.
they are doing, what's the risk appetite that they have, and what actions should they take in terms of investing going forward. Um, and if you see, like, I think that education has somehow, it has taken off in the equity markets. It's not that
Hmm.
bad right now. Like, people actually understand, different kinds of funds and different kinds of, opportunities available, etc., etc.
Hmm.
I think if you see some statistics, the the fraction of regular mutual funds have consistently come down, and have conceded ground to direct mutual funds. I still feel that if you're not that educated, then you should still there is still a case for regular mutual funds. But the statistics show that direct mutual funds have been growing year over year at a consistent pace. I don't have the numbers, but and that goes on to show that the awareness has actually happened.
Hmm.
The same kind of awareness, when if we can bring to fixed income market, that would cover broadly the entire market. And then, of course,
Hmm.
like, regulators have to keep checking if all the stakeholders are doing the right thing. um, Good folks like Alt Investor and Mint's personal finance, I think, do a long they go a long way in, touching base with, like, the real investors on the ground. So yeah, I think
Hmm.
all the stakeholders of the ecosystem have to come together for this.
Yeah, thank you, Vaibhav. Neil, I'll actually touch upon that controversial question which I wanted to skip earlier because the audience wants to talk about it. What do you think about the Hindenburg report on SEBI and the SEBI chairperson from last night?
Okay, so before I give my thoughts on it,
Yeah.
I want everyone to take note of the fact that right now we don't have any factual clarity. We have allegations, and we have some people on social media who are countering it or substantiating it. The noise level has gone through the roof. So,
Hmm.
first thing to do is take a step back and wait for some proper facts to be established. And I hope they are. So, that's my next point. Um, this should neither be shoved under the carpet because, you know, the powers that be don't want any discussion about it, nor should it be, nor should people do a kind of trial by media or arrive at a judgment just based on what is out there. I think
Hmm.
there should be an impartial inquiry into this, like whatever form it takes, whatever the government deems fit. Um, and from an investor point of view, the risk is that if our regulators, if there are questions, if they can't be trusted, then the system as a whole is vulnerable. It can't be trusted. So, so the genie is out of the box. There has to be proper impartial inquiry. Before that, I will not form an opinion. Before that, I will not form a judgment. I'm just going to wait and hope.
Hmm. Fair enough. Okay. That's Neil Borate for everyone who was asking the question. We'll come back to our main topic. Weber, the next question is for you. You talked about equity and debt. They both have different types of risk associated with them. Equity market is on a high right now. Debt is picking up naturally in India. People want better options than fixed deposit. But as a normal retail investor, how should the risk be evaluated in each asset class? There are different ways to look at equity. There are different ways to assess risk in debt. What things do matter?
Okay, good question. So I am trying to think how to, where to start, because it's a long topic. Like, you can
Hmm.
go all and on. These are broadly the two asset classes that exist, right? Um, the major difference, the prime difference between equity and debt is when you invest in equity. There is no the for the issuer, there's no obligation to repay your money, versus
Hmm.
debt, where there is an obligation to repay. What I mean by that is, debt is a loan. Like, if you give 100 rupees in debt, or as we call, if you invest 100 rupees in debt, then the borrower has an obligation to repay you that principal of 100 rupees plus some interest. When you
Correct.
invest the same 100 rupees in equity of a company, you are buying a partnership in the company. And but the company does not have the obligation to repay you that 100 rupees. Okay.
Hmm.
Um, for example, if you buy a 100 rupee HDFC equity share, nobody guarantees that this equity share will be X or Y in certain years. Okay, I mean there are technical analysis and all that, but there's no guarantee or obligation for HDFC to make that share 200 rupees in a certain time frame. um, if you give 100 rupee debt, so which means if you invest 100 rupee bond in of an HDFC, when you are investing, HDFC will tell you that I'll give you 120 rupees after 2 years.
Hmm.
And that is the major difference between equity and debt. Everything else flows from this one simple rule: obligation to repay.
Hmm.
So since debt is fixed, it is predictable. Since
Hmm.
equity, there's no obligation, it is unpredictable. Um, when you are investing in equity, you are looking at the main parameter that you are looking at, or you should look at, is the growth outlook of the company. Will this
Hmm.
company grow from this point A to point B, which could be 10x of A or 5x of A, etc., etc. When you are
Hmm.
investing in debt, the main consideration for you is that will this company be able to survive and repay my money back, which leads to two important things: profitability and cash flow.
Hmm.
So very different lenses to look at equity and debt. Um, because there's no obligation, obviously equity comes with a higher risk. Debt comes with a lower risk because it has a predictable repayment for you as an investor. However, very different checklist. Equity, you have to see management, growth, sector outlook, etc., etc. In debt, you're looking at the profitability, cash flows, and a limited tenure for
Hmm.
the company. Like, will this company, if you are investing in a 2 year instrument, will this company be able to survive and give my money back in these 2 years? Is your major consideration.
Correct. So if I have to summarize, equity investors, when you invest in equity, you are investing from the point of view that this company will grow its profits much more and you will make X multiple of your investments. When you're investing in debt, you're ditching that profitability growth. You're just worrying about whether this company will be able to survive the tenure of the bond or that fixed income instrument, right?
Yeah, and in a predictable manner, because you know
And
that
in
my
a
100 rupee will become 120 rupees, while in equity, there's a volatility, uncertainty risk, but the returns could be uncapped, whereas the returns are capped in a fixed income product.
got it. So, Neil, if I have to talk about fixed income products, do ratings matter? And if they do matter, how should people deduce these ratings? What I'll do is quickly put up the rating chart on the screen for everyone to see as well.
Yeah. So I think ratings are a good starting point, and in fact, if you look at mutual funds, also many fund categories are based on ratings. So corporate bond funds have to invest most of their portfolio in AAA bonds. Credit risk funds have to invest most of their portfolio below AA minus. So SEBI itself is saying regulators saying ratings matter.
Hmm.
Of course, they are not the be all and end all, and we discussed that I think going ahead. But it is very helpful, and there's been a cleanup. Like what used to be the case 5 7 years ago, after the big accidents of 2018, there has been quite a big regulatory cleanup of the ratings agencies. So now I
Hmm.
would trust them a lot more.
Hmm. Okay. You mentioned accidents. What sort of accidents happened?
So the big one, as most people would know, is ILFS 2018, followed by and ILFS included all of its group companies, its subsidiaries that were held by various
Hmm.
mutual funds and even direct investors. Then we had DHFL, the next big accident, and
Hmm.
the third one, of course, is Yes Bank, and that was probably the biggest blow to the system because it was a bank, a regulated commercial bank under RBI.
Hmm.
So those three have changed the landscape for us all.
Hmm. But then the regulator took strict action, and the rating agencies now are much more trustable, according to you.
I would say so, yes.
Okay. And Vaibhav, if I can ask you how to read this rating table, I mean, of course, there is a highest safety, high safety, but within the ratings also, there sometimes platforms mention positive, negative, stable. What do these things mean?
Yeah, so thank you for putting this chart out. So as you go from top to bottom, the in fact the rating definition is also there. So highest safety is triple A. As you go top to bottom, the risk basically increases, and the ratings are called from AAA to D. There are also bands. So between A and double A, there will be bands A, A plus, double A minus, and double A, which is basically, the degree of safety between a double A and A. Triple
Hmm.
B, where you have put moderate safety, is usually called investment grade. So anything that is above triple B are called investment grade securities. Anything below triple B are, the risk is particularly high in those kind of investments.
Okay.
Um, yeah,
And if I have to talk about the default, credit default rates for the last 10 years, viewers can probably see this chart for AAA rated instruments for the last 3 years. I think there is a 0% default history. This data is from CRISIL ratings. I think this is for FY 2012 to 22. Uh, uh,
yeah. So if you just see as you move from triple B to double B, there's a marked difference between the default rates that happen. And that's why that level is called investment grade.
Got it. So triple B and above is called investment grade. Below that, it's not called investment grade. Okay, fine.
Yeah.
Uh, okay, let
They're
me
called
stop
junk bonds,
sharing.
right?
They are
Below
called
triple
junk
B.
bonds, and globally they are called junk bonds. Okay. So Weber, within fixed income as well, and this is the most common question in the alt investor community as well. There are two options within bonds: unlisted bonds and listed bonds. How does the risk differ in these two different types of bonds?
Sure. So see, listed bonds are the bonds these are debt securities that are listed and traded on recognized stock exchanges like National Stock Exchange and Bombay Stock Exchange. What it does is that because you have to list these bonds on these exchanges, there are a lot of regulatory guidelines or things that you have to do, be it the disclosures, the diligence, etc., etc. Just for an example, like even to list a bond on a stock exchange, you have to file an application. The stock exchange has to approve your filing application, uh, and then the listing will happen.
Hmm.
So the listed bonds, and if you these are privately listed. I just spoke about privately placed listed bonds. There are also public issuances of listed bonds. In public issuances, the mandatory disclosures and requirements are even higher. Like you have to appoint a
Hmm.
merchant banker. You should meet some net worth requirement, etc., etc. You have to appoint rating agencies to get those ratings, so on and so forth. Hence, listed bonds follow a lot of stringent disclosures, monetary requirements, and hence are inherently lower on risk because
Hmm.
the issuers have to follow all that for their bond to be listed on the exchange, and hence inherently carry certain lower degree of risk. If we come to unlisted bonds, you don't have these requirements. You are not listing it on the exchange. It is basically the company and you as an investor, a contract between the company and you as an investor. Uh, and once the investment has happened in listed bonds, you have to also follow periodic monitoring, periodic submission of your financial statements. Those things don't happen in unlisted bonds. So you can still go and invest in unlisted bonds. My only advice is that if you are investing in unlisted bonds, then you should really really know the company,
Hmm.
because there will not be these regulatory bodies to come with those safeguards if you are investing in unlisted securities. Um,
Hmm.
but yeah, if you really do your due diligence well, then of course you can go with unlisted bonds. But if you're a common investor, if you're investing on platforms, then I would say that you should definitely restrict yourself to listed securities and listed bonds. One other point is obviously because these are listed securities. In case of listed bonds, they can be traded through the exchange. In
Okay.
unlisted bonds, because they are not listed on an exchange, the only way to make a transfer is OTC transfers or over the counter transfers. So there is no exchange for you to trade the unlisted bonds. It only happens on an over the counter market.
Got it. Okay. And Neil, I'll come to you for the next question. What is SEBI or RBI doing to minimize the risk within, this corporate bond market as well, and other alternative investments as well? Because I see the most common question that is coming on YouTube right now is what are the risks associated? What is SEBI doing about it? Are these platforms regulated by SEBI? Have regulations matured enough or not? So, what's your take on that?
Sure. In fact, before I answer that, let me just add one more point to Vaibhav's answer on
Sure.
listed versus unlisted. So, in case of unlisted bonds, if you see the budget that got passed, the July 24 budget, it has put them all into Section 50AA, which means slab rate taxation regardless of your holding period. It's a terrible tax position to be in. For listed bonds, on the contrary, if you hold them for more than 1 year, then the long-term capital gains tax falls to just 12.5% on par with equities. Now
Hmm.
there is a debate, an argument that what if you have accrued interest? What if you have interest on those bonds which hasn't yet been paid to you, but it has been factored into the bond's price, and you go and sell that bond and you make a gain. In that case, you get the benefit of a mere 12.5% in tax rate. A lot of people are going to try and take that. There could be litigation over it, but one interpretation of it is that yes, you can. Um, and on the other side, if you're a buyer of these bonds, somebody has sold you a bond with accrued interest, then and when that interest is actually paid, it will be paid in your name, but you're not getting the full amount of interest, but you are paying the tax on the full amount of interest. It's unfair, it's a burden on you. So how do you deal with that? So I would
Hmm.
say that before anyone trades in bonds, they should figure out these angles. They're extremely important. It's less of a problem with the monthly coupon, monthly interest, because then maybe you're dealing with 10 days of interest or 15 days of interest. But if you're dealing with even an annual coupon, you could be dealing with several months of interest that is paid to the seller and not the buyer.
Hmm.
So I think this thing needs proper tax clarity by the CBDT and also by an interpretation that's accepted by the industry as a whole. Um, Now, and Weber, I don't know if you want to add to that, but I'm sure you guys get this question a lot. That what do you do about tax when you do bond trading?
Yeah.
Um,
See, this is and Neil, we were speaking about this earlier. It's a very nuanced topic. I think we are still at the stage where people, have questions around what is YTM and how is it different from coupon rate. What are ratings, right? What we are talking about to the audience, it's a really really important question that Neil has brought up on accrued interest and how should the capital gains be treated. But I think Yash, for this discussion, it will become very technical.
Sure. Okay, that's
Okay,
fine.
okay.
Uh,
So I would just say consult your CA before buying.
yeah.
On the question of regulators, I think SEBI has done a fantastic job on alternative investments. And if you just take the case of bonds itself, there were all of these unregistered, unregulated bond platforms. 2, 3 years ago, it was a wild west. Then SEBI came out with the online bond platform regulations, which strike that right balance. All regulations have to strike a balance between consumer protection and industry growth, and I think the OBP regulations perfectly get that balance, where you as a consumer, you're assured of dealing with an entity that's under SEBI. If some fraud happens, if something wrong happens, you have somebody to complain to, somebody to hold accountable, the concerned platform. um, and in case of other alternatives, also this same thing has happened. So again, if you think of fractional real estate platforms, earlier totally unregulated, now the first SM REIT license has been issued.
Hmm.
Within a few months, you will have those SM REITs trading on exchanges. So So fantastic job from SEBI's end on this.
And the RBI NBFC P2P as well, right? That's also an alternative which is regulated.
Yes, yes, yes. That too has cleared out some of the issues. I know there are some pending issues that probably need clearing out, but yeah, RBI also has helped.
Sure.
Yeah.
Okay. Uh, Good, Vaibhav.
I was just going to say, like, I 100% agree with Neil. At least I can speak on behalf of OBPP regulations. I think SEBI is doing a fantastic job where, it is still thinking about expanding the market while keeping the regulations in place. All the recent circulars and guidelines by SEBI are all tailwinds for us, like, reduction in face value, et cetera, et cetera. So yeah,
Hmm.
100% agree with Neil there. And so GRIP there is also an OBPP association now. So think about Amphi, and now there's an OBPP association. GRIP has been the founding member of the OBPP association. So, the kind of conversations that we are having with SEBI, NSE, other regulators, it's just very heartening to see the kind of ease
Okay.
that has come into this.
Great. Great. Uh, Thank you, Vaibhav. Neil, a lot of unregulated products and platforms in the alternative category has also, started coming up, or they have already come up. Some of them in big trouble. One of them being agri investment platform. And actually, this is a question asked by on YouTube by Pankaj Mathur as well. What about invoice discounting and agricultural investments? Are these regulated? And the question I want to ask you is, how can investors identify risks on these platforms and probably stay away from them or consciously invest in
Yeah, so in both these areas, they are mostly not regulated. I think with invoice discounting, when they are packaged as SDIs, then they do come onto the traded universe and they do come under SEBI.
them?
Correct me if I'm wrong, Yash.
No,
But
that's correct.
obviously, yeah, so agri investment is completely unregulated, and there have been fraud after fraud. I mean, if you think back to the 1990s in the plantations, and what happened with Gropital was just the next variant of that, where they were operating without the permission of SEBI CIS Collective Investment Scheme regulation. In general, if you hear of any kind of scheme to pool money, to put money into anything, whether it's a plantation, whether it is uh, digital stuff, whether it is some new complicated product, it needs permission under SEBI CIS regulations, and if they don't have that, it is illegal. So stay away from all such stuff. You act on your own risk. Tomorrow, if there's a fraud, SEBI will not come and protect you. Um, what I hope will happen is if there is a critical mass behind something like invoice discounting, which is arguably in that zone that maybe it can get more regulated. I hope SEBI will
Hmm.
follow the same trajectory as OBPs, make regulations, bring them into the zone of regulation.
Hmm. Got it. Okay. Thank you, Neil. Vaibhav, do you want to quickly talk about, how GRIP can only do regulated products and what is your risk assessment procedure as well? Because one of the questions I have got is naturally about the big spoon default that has happened. And, what is GRIP's future plan to protect retail investors from such scenarios again?
Yeah, GRIP is a fully regulated platform. We hold a license. We are a SEBI registered stockbroker. We hold the OBPP license. We were the first one to apply and get this OBPP license. So that is on the platform level. GRIP is a fully regulated platform. All our products are also fully regulated. And just going by the OBPP regulations, we can only do regulated products. Uh, we offer three broad asset classes, which are corporate bonds. Corporate bonds are regulated by SEBI. SDIs, securitized debt instruments, which are our flagship products. They are regulated by SEBI, and if there are NBFC SDIs, they are also regulated by RBI. And then we have also recently started corporate FDs, which are naturally regulated by RBI. So all the asset classes, all our offerings are fully regulated by either SEBI or RBI. Not just regulated, they are also all 100% of our opportunities are also rated so that the investor can quantify the risk associated with these opportunities. I think most of the stuff that Yash and that you and Neil just spoke about, they are not rated opportunities, they are not regulated opportunities, and so on and so forth. Hence, the risk is more of like I say, you say, versus an external agency putting a stamp on that opportunity. um, I would still take that big spoon question. So when we were doing big spoon kind of opportunities, OBBB regulations were not in place. Those opportunities we were not doing through our the product that we have now, and that's why. And I would still say that that was the only opportunity that went south in 1,000 crore portfolio that we did. Okay. Having said that, our SDI concept comes with a security cover, a lot of other safeguards. There's an independent trustee in the middle. The whole construct is so much more kosher and safeguarded for investors. That's a much better construct than the earlier one. Just coming, and I will not take too much time, but just on the risk assessment process, I just want to say that GRIP is not a marketplace. GRIP is not a platform where we list opportunities as we come across them. We have a heavy in-house credit team. We do a lot of credit work on the opportunities that we put on the platform, and then also take it to the rating agencies to have their validation and assessment on it. um, if I have to say, like, if 100 opportunities comes to us, only 20 come to our investment committee decision, and out of that 20, maybe five get listed on the platform. So there's a whole funnel and elimination criteria when we put our opportunities to our investors.
Okay. Okay. Thank you, Vaibhav. We'll move on to the questions from audience. I'm surprised by the number of questions we have got, so this might take a bit longer, but hopefully you both have a bit more time. I'll start with the first one from Dimple Jain, probably to you, Neil, because it concerns asset allocation. Can we use our funds in different alternative investment opportunities and mitigate the risk at a portfolio level? Is it just about alternatives, or should they consider traditional as well?
Yeah, that's quite interesting because financial theory says that if you have uncorrelated assets, then you are achieving diversification.
Hmm.
And that's what I think the questioner means, that you can have a little bit of bonds from an online bond platform and some REITs and some other options. Um, yeah, I mean, it'll absolutely cut down your risk, but the only thing I would say is don't make it the core of your portfolio. The core of your portfolio has to be highly regulated products and tax efficient products, which I would say is mutual funds.
Hmm. Okay, got it. Thank you, Neil. Weber, next question to you. When will Grip Invest launch mobile app?
Oh my God. So every webinar that I do of GRIP, this is the constant question that we get. I was hoping that I'll not get this question today, but there are people who are waiting for this. Um, yeah, I think so. We have started work on it. Uh,
Sorry, Weber, we can't hear you. Uh,
can you hear me now?
yeah, we can. Yeah.
Yeah. So I was just saying that we have started work on this. Very soon we will have our own app. Um, give us another quarter or so, and we'll have our app.
Okay, great. Uh, Question from Pankaj Mathur on YouTube. How can retail investor keep his portfolio in sync with the changing market scenario? Neil, do you want to take that?
Oh, that's a hard one because
Yeah.
nobody tells the retail investors anything. Our industry is designed in a way that it's manufacturers talking to distributors and then distributors filtering things at their level, and then something comes out to retail investors. There is very little honest, transparent, direct communication, even through the media, because manufacturers don't talk. um, and it's complicated stuff. I mean, how do you know that somebody you invested in the company now is in trouble? It's and whether that trouble is enough that you should sell it or not. The only solution to all of this is really to have good advice from a SEBI RIA, and if you can't afford it, then stick to the core, relatively low risk products. Don't get into the fancy stuff.
Got it. Okay. I have another question again for you, Neil, from Rahul Singhal. Are corporate bonds better than debt mutual funds?
Okay, so again, an interesting question because there is no clear answer. So I'll give you the case for corporate bonds and the case for debt mutual funds, and it depends on your circumstances. So in case of corporate bonds, the best part is that you know exactly, if you hold to maturity, you know exactly what yield you're going to get, how much you're going to get every year at what frequency. The other part is that, assuming it's a listed bond, you have some amount of liquidity. Assuming it's listed and well rated, you have some amount of liquidity. In case of tax, again, this budget has greatly improved that taxation. After 1 year is 12.5% if you sell the bond. Um, on the flip side, of course, you might not get diversification. It will take lakhs of rupees, maybe crores, to get a portfolio of 50, 60, 100 bonds. That hopefully will come down once the new 10,000 rupee minimum ticket size, issuers start issuing bonds of 10,000 rupees. But for now, ticket size is still a problem with corporate bonds. And then there is that whole monitoring bit which you just asked in the previous question, that who's going to tell you if something's going to default or not? Who's going to tell you when to sell? Whereas a debt fund manager will take care of all of this, will take care of um, which bonds to pick, monitor the ratings, all of that. The sort of bad side, or the minus point for debt mutual funds, one is taxation, that no longer how long you hold it for, it's always going to be taxed at slab rate. Of course,
Hmm.
there is tax deferral. So until you sell the debt fund, you are not taxed. Whereas in case of a bond, you keep getting interest, and so you keep paying tax. Um, but I mean, the answer, so I'm throwing a lot of points out there, but I think the answer really is on who you are. If you just want a file it, shut it kind of approach, I would say debt mutual funds. If you have the time, the interest, and the expertise, then corporate bond.
Okay, fair enough, Neil. Vaibhav, I want to come to you because I think Grip has an interesting product called Baskets, right? Which is technically amalgamation of different corporate bonds into one basket created by an RA, right? Do you want to
Yeah.
quickly talk about that as well? And then from the mutual fund perspective, you have other alternatives like AIF and I think PMS as well, right? Can you quickly talk about that?
Yeah, so we started this product called Basket with the same logic. Like, so there are different bonds. How does a retail investor, think about these different bonds? How to create that diversification? So we created a product called Basket, where it is a theme-based investing in fixed income where 4 or 5 bonds are pooled into one product called basket. So when you invest in a basket, your money is automatically diversified into 4, 5, or 6 corporate bonds. So it is kind of like a mutual fund, but it's also kind of like a small case by for equity. But what Neil was saying, in a debt mutual fund, it's kind of like a black box. Fund managers can change, the thesis can change, the YTM that you expected at the time of investment may not be the YTM when you are exiting. Whereas in a basket, you are investing in a fixed income, fixed YTM product, and you will get what you signed up for. Uh, and that was our way to do like a stress-free, one-click, auto-diversified investing for retail investors. It's a very interesting product. Actually, we've got a lot of traction. 30% of our orders are now coming in baskets because for retail investors, you don't know how Navi is different from Vivriti, right? Both are
Yeah.
A-rated bonds, both are NBFCs. And to Neil's point, like public issuances are now at 1,000 rupee face value. Privately placed bonds will come at 10,000 rupee face value. So now you don't need 50 lakhs for a diversified portfolio. Like one of our baskets starts at 4,750 rupees with 5 bonds. Um, Okay, sorry about the plug, but we are quite passionate about this product that we recently launched.
No, appreciate it, Vaibhav.
Why not
Uh,
5,000 exactly, Vaibhav?
Because the fifth bond face value has come down to 750 because first principal repayment has happened. So
Okay.
it's four bonds of thousand rupees, and the fifth bond is 750 rupees.
Question from Sonal Banerjee to you, Neil. What are your thoughts on the evolution of various alternative investment platforms in India? Do you support how structured products are now accessible to retail investors?
So, I'm glad that this industry has developed and has gotten formalized. But with one caveat that I would not say retail investors. I would say this is meant for, as I said before, somebody who has the time, the expertise, and a little bit more money. If you are a 5,000 rupees SIP kind of person, this is not for you. But if you have some portfolio, and like I said, the expertise, then yes, you can get a little bit more, a bit of an alpha from it.
Hmm. Okay, fair enough. Uh, Question from Arun to you, Vaibhav. Is it possible to generate consistent high returns over a longer time frame? Bit of an abstract question. Depends on the skill set, but yeah, any opinion on
Yeah, if I could answer that correctly, I would be the next Warren Buffett.
that?
Um, But see, very abstract because what do you mean? What is high returns for you? What is
Yeah.
consistently over a long period of time mean for you? Uh, I think, see, in investing, and I would sound so cliche, but I think discipline is the key. When I talk about discipline, it is staying invested into the market, checking on your asset allocation. If you do that correctly, then I think it's very much doable. Do People should not run after like 20%, 22% headline numbers. They should continue with discipline, or even FNOs. They should continue with discipline, and I think I can say that you can easily make anywhere between 14 to 16% over a long period of time. And when the money is compounding, then 14 to 16% is a phenomenal
Fantastic number.
uh,
Yeah.
compound rate.
Okay.
Yeah, but no magic bullet for this.
Okay. Thank you. Neil, question for you from Jagdamba. Which rating agency ratings are more reliable?
I think the top ones are pretty much similar. So a CRISIL or a CARE or a ICRA will not be that different. The smaller ones, look, there have been accidents in the past. It's not a statement out of thin air, but if you think of something which is a Brickworks, for example, I would want that to be supplemented by one of the top ones, CRISIL Care. I would not rely on a smaller rating agencies by itself.
Okay. Uh, Another question again for you, Neil, from Bharat Kumar. Observing HDFC Bank is not performing in the market for the past few months, and majority of the funds have nearly 10% of their holdings in HDFC Bank. Do you recommend to avoid these suggested funds which hold HDFC?
So I don't have views on individual stocks, and I do not suggest mutual fund investors should have very strong views on individual stocks, because if they do, then they should be stock investors. If you are a
Right.
mutual fund investor, then you should leave the job of picking stocks to the fund manager and trust in them. If that fund manager has chosen badly, then that will show up in the returns, and that person will lose credibility. They will lose whatever strength they've built in the past few years. So that way you can pick any stock. I mean, there was ITC that was held by so many mutual funds, including one that I invest in, and they got so much flag for it. And my approach was always that I'm not going to open the engine and then say that, oh, this part needs to be something else. I'm going to, as long as the car runs, I'm okay.
Hmm. Fair enough. Excellent. Weber, question for you from Bharat Kumar. I just recently started hearing about SDI. How does this really benefit compared to other investment options? Probably we can talk about the DHFL scenario where the NCDs were defaulted and the SDIs never, uh, or
Yeah.
feel free to add.
Okay, first, Bharat, glad to hear your interest in SDIs. SDIs are the flagship products that GRIP have introduced. They are called securitized debt instruments. Um, how are they beneficial? So, these are again SEBI regulated products, come with a robust security cover, are credit rated, and the benefit really is that compared to the similar rated products, SDIs offer a 150 to 200 pips alpha over other products. So, and if an A-rated corporate bond is giving 11%, an A-rated SDI, we are able to offer anywhere between 12.5 to 13%. So that's the benefit of an SDI. I don't think I'll be able to explain SDI as a product in the interest of time, but please feel free to reach out someone at Grip, and we'll be very happy to answer. Um, Sorry, I missed. Yes, did you ask me a second question?
No, no,
Okay,
that was
yes.
enough.
Just one thing. So STIs are, in a way, the security cover is higher than a corporate bond. So what Yash was saying, there have been instances in the past where NCDs of a certain companies have defaulted, but SDIs or PTCs of the same companies have not defaulted. So generally, the security is higher, and SDIs are also rated higher than NCDs of the same NBFCs.
Okay, thank you. Uh, Another question from Bharat Kumar. And gentlemen, I'll start picking up questions because these are just unending. There are more and more questions coming. I'll just select a few of them now. So Bharat has asked, how should our asset allocation be planned when the stock market is falling, with good returns apart from fixed debt or bonds? Like, so question is, if the stock market is falling, where should I invest apart from fixed income instruments or bonds? Neil, any opinion on that?
Yeah, I would say that an SIP would take care of a falling stock market really well because you're getting units of mutual funds, more and more units as the stock price falls. And if you're a long-term investor, the period of fall will not matter. Um, in terms of protecting yourself from that fall, because on the one hand, yes, you're looking at the long term and you're building units. On the other hand, the value of your portfolio is going down and then down and then down. So you have fixed income and then you have gold and real estate. Don't forget these are also good diversifiers.
Sure. Okay. Uh, Another question from Rupam Chaudhary. Neil, again for you. What are regulated platforms for fractional ownership of commercial properties? I know you're quite passionate about SM REIT, so why don't you do?
Yes, yes. So the first SMREIT license has been issued to PropShare. They have not yet launched their SMREIT, but I expect they will in the coming couple of months. And as far as I know, all of the players have applied for a license. All of the big players. So Strata has applied. Um, HBits is applying. So give it a few months. Most of these guys will be listing on exchanges.
Okay, great. Weber, question from you for you from Arpit. In the worst and rare case, if GRIP plans to close its business, what will happen with retail investment across all the assets done via the platform? That is leasing, bonds, or SDM.
Great question, and thank you for asking. All our SDI products are bankruptcy reboot from GRIP. So even if something happens to GRIP, if GRIP shutters down, the instruments will continue to survive, and there will be no impact on these instruments. Same thing with bonds. You are There is a trustee, and you are investing into an originator, so GRIP has no role to play in the sense of bankruptcy remoteness.
Okay, fair enough. Another question, very GRIP specific, Weber. Uh, why not GRIP Invest introduces all infrastructure funds for HNIs like Edelweiss brought, where the returns are very high?
Okay, interesting. So Grip has now launched, besides the platform, we have also launched an alternative investment fund. This is a fixed income AIF, and we have also launched a PMS. Um, these are not infrastructure funds because that's a very sector specific fund. But if you're interested, please reach out. And yes, like my email will be available, right? It's Vaibhav at
Sure.
gripinvest.in. And we have launched an AIF and PMS as well.
Okay, great. Another very grip specific question from Arpit. Will grip plan to provide extra protection or safeguard for any of the deals from their side, maybe up to some particular investment limit? First of all, is that even allowed from a regulatory standpoint? I don't know.
Yeah. So, Arpit, in all our opportunities, there's a security cover, which in a way is an FLDG, first loss default guarantee, where originator has put in some cash collateral, over collateral, excess interest spread, so on and so forth. That forms the security cover, and it's kind of like a security if something goes wrong, and the trustee can invoke that and dip into that security. Having said that, GRIP as a third party providing this FLDG is actually not allowed. And if some other platforms are offering you this kind of, um, fixed guarantees and capital protection and all those things, it's only a matter of time that those things will go away. The only way
Yes, or insurance. One second.
Yeah, it's okay, Weber. We lost you for 1 second, but we can hear you again.
Okay, I think. Am I audible now?
Yeah, you are, but a little less voice.
Yeah. So I was saying that the only way to really do this is through CDS, credit default swaps, or through insurances. And those are some things that we are figuring out right now. But we'll only do this once we have full regulatory clarity. We don't want to do things like capital protection by grip, default guarantees by grip, because, and Neil would agree with me, those things are not those things are not regulate on the right side of regulations.
Okay, great. I'm sorry, guys, my voice is echoing. Weber, yeah, okay, now it's not. Just wanted you to go on mute. Last question for the day. Uh, Again, grip specific, sorry, Neil. But Pankaj Mathur has asked, why not have a basket of different asset classes of on the grip platform? So maybe equity plus bond basket or something like that.
Oh, great, fantastic. See, Grip is primarily a fixed income platform. We don't do equity right now. Within baskets, we have done bonds plus SDIs. Within SDIs, there are different kinds of SDIs. We have done that as a basket. So we are, bringing more and more opportunities into baskets. But yeah, but the point well taken. And if I can just take another 10 seconds, there are theme based baskets. Like if you want to do only short tenure investments, if you only want to do gold backed investments, if you only want to do high rated or very safe investments, those are the different kind of baskets that we have launched. Um, but we'll continue to bring more permutation and combinations on that.
Okay, thank you, Weber. Weber, can you go? Yeah, okay, Neil. Neil, anything closing thoughts to add from risk point of view? How should people really think about risk? I know we have talked about it a lot, but any closing mantra that you also abide by when you have to evaluate risk?
Yeah, yeah. So, on a positive note, I think the blossoming of alternative investments has actually decreased the risk in an overall portfolio. If an overall portfolio only has equity and standard debt, you may not actually have enough diversification. So, if you also have real estate through a REIT, you're adding a bit more diversification. That said, psychologically, we find it very hard to deal with losses in debt. So when it comes to bonds, even if it's 1% of your portfolio, if you have the word default on your screen, it's going to give you sleepless nights. It's going to cause trouble. So just make sure you're psychologically prepared to deal with it, because equity, we are all wired differently. We know long term hai, we'll hold. debt mates are very different wiring. So keep that in mind with alternatives. And final thing is complexity. Like this is complex stuff. If you do not understand it, do not invest. Take the time to understand it. Attend more of these webinars. Reach out to Yash. Reach out to Vaibhav. And I'm sure they're okay to, if you ping them a lot and trouble them also, they'll still answer your questions very patiently. So do that homework before you invest.
Uh, Thank you, Neil. Um, okay, I want to end it here. Would like to sincerely thank the audience who patiently has been watching this. I think we still have around 100 people watching this right now live. So really, thank you very much. Would like to thank you both, Neil and Weber, for sharing your insights with the wider audience. For our audience, if you like this webinar, please don't forget to share this video. It will be available on LinkedIn and on YouTube. And if you want to learn more about alternative investments, I run a community under the Alt Investor brand. You can just go to my website and join the Alt Investor community if you're not a part already. We'll try and place the link in the comments below as well. But yeah, thank you so much, Weber and me. Thank you so much for your time.
Thanks, Yash.
Thanks, Yash.
Thanks, Neil. And thanks,
Thanks, Vaibhav.
audience. All right.
One
One
second.
second.